Good afternoon. I don't think I've ever given a 20-minute speech before. I'm talking about the economy, and fortunately, my indicators are simpler than most economists, because people drive our economy. 70% of our GDP is consumer spending, and the people doing that are people who enter the workforce precisely on average at age 20, earn and spend more money until they're 46, and then they slowly pay off. It's the biggest factor driving the economy, and not something economists focus on. They think monetary policies are more important, and right now it's everything. But let me give you a clue. The reason, I always ask this question, isn't there something wrong with an economy when for 14 years they have to keep printing more and more money and keep stimulating and stimulating and stimulating? There is. The baby boom, the largest generation in history, peaked in their spending as a generation, and we're in between them and the millennials, which kick in about a year or two from now. So the younger people are going to drive the next boom, and the baby boomers are going to do one thing over the rest of their life: retire and die, okay? So my view is people are predictable, and people most drive the economy. Is this working? Okay. And the economy's complex, but everything is also simple. So I focus on the simplest driving factors, and there's always a few. And I tell people, most economists will literally tell you nobody can predict the economy past the next election because it's all politics. I don't look at politics at all, okay? First of all, you can't predict it that well, and they're not as important as they think they are, politicians, okay, from my view. So I look at trends over the rest of your lifetime. In other words, I can tell your kids or grandkids what the economy is going to kind of look like in different countries around the world when they're in the workforce or when they retire decades from now. So I'm the opposite. I'm saying the long term is actually easier to predict than the short term because there's aggregate trends that are big on a macro level. It's easy. The short term is more difficult because we can have, economic stuff, political stuff, all, plagues like we have and all this stuff, COVID. Now, took me 40 years. I started with this cycle. Generation cycle of spending, extremely simple, I'll show. I added the other important cycle is technologies. Technologies have life cycles just like people do. It's called a 4-stage S-curve model. I studied that with my big thing in Harvard Business School and Bain & Company. We consulted the companies on showing where they are on their 4-stage business model and how their strategy has to change now and in the future. So these are predictable things. They have life cycles of technologies, which affect productivity, life cycles of people, and just like I said earlier, 20 to 46 is the leverage point. That's where people grow in productivity and spending the most, and spend the most in their lifetime. And then there's a geopolitical cycle that's less important, but it kind of affects stocks more. Things look good in the world, the stock market will be a little healthier, but this does not affect growth. Now, this is my indicator that I got in 1988, so I've been using it a long time. The spending wave. Now here's how simple this is. The blue background is a 46-year lag on the birth index, in the United States in this case, and adjusted. The hard part is adjusting it for all immigrants, which I can do that's a little harder, but I can do that with a computer model. So when are these people going to reach 46, their peak spending? And then when I do that simple lag, it pretty much tells you the booms and busts out as far as you want to see. This would go out to 2060. And you look at look at the baby boom generation, and look at the millennial generation to follow it on this side. I hear one economist, one expert, the millennials, there's more of them, they're going to drive our, No, they are nowhere near the wave the baby boom was, as a wave of people. So yes, there will be a boom, 2024 to 37, but it will not be as dynamic as what we saw from 1983 to 2007. But again, the stock market correlates with this long term. This is the data behind it. When I went from big business consulting to small entrepreneurs in the early 80s, and they were the ones targeting products to the young baby boomers, and that's how I tripped on the baby boom generation and how big they were going to be as they grew up. So this was, I pulled right out of government statistics, Economists will never pull up this chart, but it's the most important chart there. This is the spending cycle of the average household. Now, people aren't predictable individually, but it averages incredibly. Again, 46 is the peak. There's a plateau into 54. That is the people, the more affluent people that went to college and have kids who probably go to college, so their spending wave is a little later, but they're also the minority. And then it drops off. I think this is the surprise. The rise would not be a surprise, even the peak, but look how much it drops off. Once people raise their kids and buy that big ass house, what else are they gonna do? They've blown their whole wad. So this is a very dynamic thing, and this is why this works. People do this predictably, on average, and this is what drives booms and busts more than any other factor. Now, here is Canada's spending wave. I can do this for any country in the world, especially developed countries. Canada's is like the US, big baby boom, but note Canada has a millennial generation that's a little larger and takes them to new highs. US doesn't. The millennial generation just takes us back to where we were at the peak of the baby boom, and that was back in 2007. And again, why all this stimulus? They're making up for the lack of spending when baby boomers peaked, and the Generation X, they call it, that's the smaller generation, that's the declining birth tide. There's not as many of these people to drive the economy and buy houses and spend money and all this stuff, so they're printing money to make up the difference. I don't like printing money, okay? It perverts the economy. I don't believe in something for nothing. So I think we're about to get a big bust just to correct all the money printing in the last 14 years in the next few years. This is a broad long-term cycle. Every 90 years, this is two of those technology cycles I showed earlier, but every 90 years we get super bubbles and super crashes. So the last one was 29 to 32. Before that, 1835 to 1843, super bubble and super crash. These are what, this is what causes depressions instead of recessions. Recessions are a correction when business is going along, we just need to clean out stuff and get rid of some bad debts and bad companies. A depression is shaking out an entire bubble, which creates a lot of debt and a lot of financial asset appreciation. It has to come back down to reality. That's why these are so severe. This is why the government, Ben Bernanke, he was the Fed chairman when we hit the 2008-9 recession, and it was deeper than anyone we've seen since the Great Depression. His thesis was the Great Depression. He saw 2008 and said, holy crap, this looks like 1930. I'm printing money. I'm not going to let this happen on my watch. And they've just been printing money ever since. I just don't get why people don't get that if you have to keep printing money forever, 1 year would have been fine if the economy just had a short-term thing. This is a long-term slowdown that they're fighting with printed money. Here is the result when you do this sort of thing. Financial assets, the biggest bubble in the world is financial assets. $573 trillion. Now, why is that important? That is 6 to 7 times, 6 going on 7 times global GDP, and normally in history it's 2 to 3. So what we have is the biggest financial asset bubble in history, and that financial asset bubble has to go down 50% just to get to normal, and nothing goes back to normal, it always goes lower. And that means people in the world, and I'm predicting, I could be wrong about this, but I don't expect to be, next 2 to 3 years, $250 trillion will disappear from people's brokerage accounts and bank accounts. $250 trillion, 3 times global GDP. So this is going to be more people losing financial assets than a recession and losing jobs, although that will happen too. So this is a different type of downturn, and you only get this on this 90-year cycle. Money disappears. Here's what the Fed has done since 2008. First whack, $1 trillion, Ben Bernanke, should have been enough. It wasn't, they had to keep going, and then they had to step in harder. They're starting to go into failure in 2014 again. 3.6 trillion printed out of thin air. That is nothing compared to what happened since COVID. 5.1 trillion, almost 25% of our GDP printed just to keep the economy barely growing. because this is not the best economy we've ever had, even with all this stimulus. So again, this much stimulus, this weakened economy, what would it be like if we didn't have the stimulus? We would be in a depression. 2008 to 23. I was predicting that back in the 1980s, just by this demographics. And here's what the stock market has done compared to what the fundamental says should have happened. So something's got to give here. I don't think the economy's going to come up, the stock market's got to come down. So this is a crash of a lifetime. I hate to say this, I know it's not good news, but somebody's got to tell you, or at least warn you, because again, money's going to disappear faster than people blink, and it's not going to come back. Markets are not going to go to new highs a couple years from now like they've always had. But down, correction, good, back new. Not going to see new highs for at least 15 years, if we ever see new highs. Why? The next generation is not as large as the baby boomers. It only takes us back, and they will have their boom in a non-bubble era, because bubbles inflate financial assets. So I really don't think real estate, number one for sure, or stocks will even get back to where we've seen them in this boom. That's a big deal. So you got to be a smarter investor in this environment. This is the most important chart, and I stole it from Dr. Lacey Hunt from Austin, Texas, my only real economist that I like. He somehow took normal PhD economics and didn't get screwed up with it, okay? Money velocity. This indicator tells you something very simple. When it's going up, money is being invested productively, getting good returns, and then being reinvested. When it's going down, money's going into speculative stuff, like bubbles, in financial markets going up for no good reason, money printing and stuff. And what the last time we had money velocity drop like this was 1918 to 32, and what did it end up in? Roaring 20s bubble, Great Depression, crash. Not recession, depression. This is even worse. Money velocity went up higher and has fallen even more. This chart says there's no way out of this other than a big clean out depression. Largest country in the world. People think China's going to grow forever. They got a bunch of young people. They don't. Japan was the first developed country to peak in their demographics and spending. China had already peaked in 2011. People don't even know that yet. They've been growing on urbanization, and they're running out of room to do that. Rapid urbanization and huge stimulus. They have overbuilt their economy by 20%. So that even the future people that are still going to go in the cities will never need to build a house again. They've overbuilt everything. China is the epitome of this bubble. The US was the epitome, the driver of the roaring 20s bubble. So China's going to have the biggest crash. Here's real estate real quickly around the world. Can you think? The biggest bubbles, Hong Kong, Beijing, Shanghai, and guess what after that? Vancouver. How many people are actually from Vancouver? Okay. My favorite city in North America, okay? I wouldn't touch real estate here with a 10-foot pole. Most overvalued city maybe in North America. Why? Because it's so great. People always come to me at the press and say, oh, but Harry, my city's so great. Then I said, well, that's why you bubble. They say, we can't go down because we're such a great city. It is the great cities that bubble the most. And all bubbles do one thing, crash, back down to reality, which is good. I was talking last night at the cocktail party to a younger person, with her father. And it's like, you're the winner here. If I'm right, all us baby boomers own all this overvalued crap, are going to lose our asses, and you're going to be able to buy a house for the first time for half the price. This is good for the millennials coming along. Here's a long-term chart that says the downside of this is as low as 670 on the S&P. It's gotten up to 4640. I think that probably was a peak. But this is, again, only crash to compare to this was 29 to 32, down 89% in 2.7 years. I'm projecting this could be as much as 87. I don't know what the government is. They're going to try to stop this. You got to remember, they're going to lose a lot of credibility. What they just did in the last 2 years, $5 trillion in monetary stimulus, way more than before, as I showed, and another $5 trillion in fiscal stimulus, which hits inflation more and hits the economy even harder, okay? $10 trillion in 2 years. You get an economy, which I'm telling you right now, my bet, we're going into recession already. We're not going to have a recession next year. I think we're on the verge of one right now, the smart people are saying. You have a recession after printing that half of your GDP, you just threw in the economy and you have a recession? The economy is dead, is what it's saying. All you can do, you're not going to say, all you do is get out of the way. You sell your financial assets, okay? Stocks, bond, everything but the safest bonds. And what are the safest bonds in the U.S.? U.S. Treasury bonds. And they're the safest in the world. We're the currency, even though they say we're too much in debt. We're the best house in a bad neighborhood. We have printed 44% of our GDP cumulatively. Europe, 67%. Japan, 128%. Best house in a bad neighborhood. Mark my words, and look at 2008. When we have this crash, if we do, the US dollar will go up and other currencies will go down. It's the safe haven, whether you like it or not. Stocks, my projection, just the first crash, and this has never happened. I analyzed all 12 major stock bubbles in the last 120 years. And the average first crash after a bubble peak was 41% in 2.6 months. So these bubbles don't have a soft landing. Everybody's saying the Fed can engineer a soft landing. Not a chance in hell, I'm saying. This one projects one of my favorite patterns, megaphones, because they only happen at major tops, that we could be down 58. We could go from 4820 down to 2,000 on the S&P in just a matter of months. First crash, 58%. That would be the biggest ever. But we've seen 50% before in first crashes, so it's not out of the park. Here's Bitcoin. A lot of people say Bitcoin's baloney. It isn't an invisible coin, by the way, okay? I say it's the next big thing, but it's an industry in its infancy. I compare Bitcoin, to oversimplify, to Amazon and .com retailing in the last tech bubble. Those were the stars. It started with the NASDAQ and broad technology. The winners at the end were Amazon and the .com people. That was the new thing. Crypto is the new big thing, but it's still in their infancy. Amazon was still almost selling books at that point, okay? Infancy. So that's the way I see it, and I use kind of like Amazon as a model for, okay, here's what could happen to Bitcoin. Amazon did crash. Now listen to this number. 95, 96%. First crash after its baby bubble, just like this bubble. So it crashed that much, 2000 to 2002. Nobody was on this problem. It was the leading retailer online. It's the leading today, bigger than ever, and it crashed that much. And then we had a great boom. I'm saying Bitcoin could go to 3,000 to 7,000, and then 15 years from now be 500,000 to a million. Yeah, 780,000, just best guess. Don't hold me to that one, but that would be an early stage to maturity projection, very similar to what Amazon and the .coms did. And gold, topic here. Gold's best correlation is with inflation. Because of the aging of developed countries, inflation is peaked in the 70s when the baby boomers were young and expensive to the economy, okay? Took an investment to raise all these crazy people and incorporate them in the workforce. Inflation just keeps trending down. But gold also has 30-year cycle on the commodity cycle. And that peak was 2008-11, and now because of this crisis, gold is rising in the anticipation that we're going to have this big washout. The problem is, when we actually have it, gold will have to go down to fair value too. Gold is bubbled as a financial asset is much or more than stocks. So all financial assets come down, except for the treasury bonds. But gold will hold up better. 50% decline, I'm predicting 86% for stocks. Weekly leading index, what I was hitting at before. This is the best index I have found, of many, but the best, and it's saying we're not heading for a recession in a year. As I said, we're on the verge, we're about to head into one now. This economy cannot afford a recession after this much money printing. So, I'm saying next 2 to 3 years we'll see the most volatile markets of your lifetime. And just be happy because it'll be over in 2 to 3 years and the millennials will pull us out of this, okay? So it's only gonna be 2 to 3 years that you gotta protect your assets, hunker down, and if you do, everything's gonna be on sale. I call it the sale of a lifetime on all financial assets. Biggest crisis since 29 to 32, once in a lifetime. Good news, we have a longer term cycle, one of the most powerful in history, that is going to go up into the next century. Our kids will see greater booms than we do because of this cycle. I can't have time to get into that. All financial assets go down. You got to protect your assets for just a couple years. And the one safe haven, the one thing that went up in 1930 to 32 and 2008 to 9, the only two things I can compare to this scenario, long-term treasury bonds. Best house in a bad neighborhood, as I said earlier. And where do you go a couple of years from now? Europe is already peaked demographically. US is kind of plateauing. Future goes to Asia, and my favorite countries in the world, Australia, New Zealand. That's where I get the best audience because they're so far away, nobody talks to them. But so there's going to be and in aging countries like Canada and the US, the healthcare sector is obviously going to lead. If I had to invest in one sector, if I had to build one thing, nursing homes. They will never, ever, ever have enough nursing homes for the peak that's going to come 20-some years from now when the baby boomers hit age 84. 84 is the number for nursing homes, 46 for peak spending, 20 workforce entry, and I can tell you anything else you want if you have a question. I know when people do things specifically. So, short presentation. That's all I have, folks. Thanks for being a good audience.